Dion, you can hear us at the back? Welcome, ladies and gentlemen, and thanks for joining us at the 2018 annual meeting of shareholders of Turners Limited. My name is Paul Burns and I'm the Deputy Chairman of Turners. Chairman Grant Baker, I understand, is hooking in by remote. Is that all happening? And we've got an apology for Matt Harrison, or Matt Harrison, so both those directors are overseas. They'll be joining us by remote. I'd like to introduce my fellow directors who are here today. John Roberts, Anthony Ryans and Alistair Petrie. I'm also pleased to introduce Martin Berry, who was recently appointed to the board and who is standing for election by shareholders today. You'll have an opportunity to hear from Martin later in the meeting. With us on the front bench is Todd Hunter, our CEO, and Aaron Saunders, who's the company's CFO. There are a number of dedicated senior managers and staff in attendance. Welcome to you all. Also, we have in attendance our company's auditors, Staples Rodway, legal advisors, Chapman Tripp, and other advisors. Thank you to all these firms that provide such valuable services to Turners. We'll start today with presentations from myself and Todd on the strategic direction, opportunities we see available to us, and our progress towards achieving our goals. Following the presentations, there'll be an opportunity for discussion on any questions you may have. We'll answer questions on the resolutions at the time they're proposed, and there'll also be a further opportunity at the end of the meeting for you to ask any other general questions about the company and our operations. The notice of meeting and the 2018 annual report and the financial statements have been circulated and made available to shareholders. A quorum is present and I therefore declare the meeting open. The New Zealand used vehicle market is large and continues to grow. There have been more than 765,000 transactions so far this year, slightly above last year. Due to the age of the fleet, we believe there are years of inherent demand. More than 20% of the current used vehicle fleet is at or very close to scrapping age. There are therefore hundreds of thousands of vehicles expected to need replacing over the next decade. Compared to the new car industry, the used car market tends to be far less discretionary. The industry sells used vehicles through 3,500 used vehicle dealers in New Zealand, and Turners has by far the biggest share, but still well under 10% of that market, so there's plenty of room for consolidation. While our focus is now more on organic growth and expanding existing businesses and services, we continue to carefully assess potential acquisitions that could add value to our group. We particularly monitor the more disruptive and innovation space. In that regard, electric vehicles get a lot of press. They're still being sold in low numbers. There are around 9,000 EVs in the country out of a total fleet of 3.85 million. So it's less than 0.25%, albeit growing. A reliable source of good second-hand EVs and further investment in infrastructure will be critical to driving more serious adoption. We actively assess what's happening from both a supply and demand perspective with a view to participation in emerging innovation opportunities. But there'll always be a need for a trusted business like Turners, which can provide multiple channels for customers to buy and sell either standard, internal combustion or EV cars, both online or on yards. Turners is able to offer all the add-ons that customers are looking for, including finance, insurance and auto care services. We continue to set ourselves challenging business growths and have achieved and generally exceeded these over the last 5 years. Financial year 18, 31st of March to 2018 was no exception, and we delivered a 32% increase in revenues to 330 million and a 33% increase in net profit after tax to 23.4 million. Todd will cover some of the highlights and milestones achieved in the FY18 year in his address. Shareholders have benefited from our growth with a higher dividend of 15.5 cents per share, providing a fully imputed return, so an after-tax yield of over 5%. The only area of performance that has disappointed is our languishing share price. As it must be a concern for all shareholders, we should take some time to discuss possible reasons and market feedback. As most of you will know, both First New Zealand Capital and Craig's Investment Partners commenced analyst coverage of Turners in 2016 with their own regular in-depth analysis of our full and interim results to provide guidance for their respective clients. As part of these regular market research reports, which I know a number of you will receive, analysts include their forecast of future profits going out 3 years and a share price target for the next 12 months based on their analysis. The most recent research reports following the release of our profit to 31st of March 2018 had 12-month share price targets of 3.29 and 3.35, so an average of 3.32. Forecast profit for this financial year to 31st of March 2019 from those two analyst reports were similarly close to each other and forecast an average profit before tax of 34.5 million, just under the midpoint of our current guidance, which is between 34 million and 36 million. We'd also expect actual earnings per share this current financial year to come close to assumptions included in those reports. So dilution and earnings per share, of course, has to be taken into account as well as the dollar profit forecast. So why is our share price currently around $2.85, well below the price suggested by conventional analysis in these reports? And it's trading at a level which the board sees value. And you may have seen directors and senior executives, including Grant, Todd and myself, recently buying Turners shares at around $3 a share. Of course, there's always a number of factors influencing a share price in any dynamic stock exchange market. And no doubt some of you will have your own ideas, which we'd be happy to hear. But feedback from shareholders that we have spoken to and market commentators suggest three possible issues at play with our share price. Firstly, the strategy in a more complex Turners business as we have acquired by acquisition other businesses. Secondly, some concern about the tightening credit cycle. and thirdly, negative sentiment from last year's capital raise. So perhaps it's worth making a few points on these three issues. With strategy, Todd and I will reinforce our strategy remains growth across our automotive and related financial services group. At quite a simple conceptual level, we have four main earning streams. First, we trade in used vehicles, buy, sell, make a margin. Secondly, we provide finance, mainly on vehicles, but on other personal finance as well, but the big percentage of it is vehicles. Thirdly, we provide insurance, again, mainly on vehicles. And fourthly, we collect debts on behalf of banks and other clients and receive commissions. So those four streams are quite easy to understand if they were standalone businesses. It gets more complex where we cross-sell our group product offerings. So for instance, providing finance and or insurance as part of a vehicle sale. But that cross-selling to an acquired customer is a real competitive advantage of the Turners integrated business structure. And perhaps we need to get that message across, that the structure facilitates leverage and cross-selling, but fundamentally we're in these four streams. Management have been working hard to share with shareholders and potential shareholders just what our business is all about. In recent months, there's been an inaugural retail shareholder roadshow. I hope some of you may have attended, which visited 9 centres, and we talked to up to 200 shareholders and potential shareholders. We also published our first shareholder newsletter and have met individually with a large number of institutional investors in New Zealand and Australia to discuss our business and our strategy. So that's strategy. The second issue raised was concern about tightening credit cycle. Both management and the board are very conscious of the credit cycle and related lead indicators. We're fortunate to have John as an independent director, John having spent 10 years as Managing Director of Credit Bureau Veda International. So John spent a decade living and breathing credit cycle analytics. You would have already seen references in the annual report to tighten credit criteria to position the business for the anticipated downward shift in the credit cycle. And you'll continue to see references to our current focus on higher quality new lending rather than a grab for any market share or focus on growth alone of our loan volumes and receivables. It's not a matter about avoiding arrears and bad debts. In a tighter credit cycle, they will increase. It's a matter of managing that and pricing the loans accordingly so that the profit from those finance activities is maintained or enhanced. The third issue I referred to was the September last year's capital raising. We raised 30 million of new equity through a 25 million placement and a 5 million share purchase plan. We explained our reasons and preference for what was quite a conservative approach at the time, and I don't propose to re-justify the board's decision now. We made what we believed was the right call at that time. However, with headlines such as growing pains for existing shareholders and dilutive capital raise, some loss of retail broker support has been an unintended consequence, and we have to regain that support. We have subsequently engaged with quite a number of shareholders and institutional shareholders, and we're aware of the strong sentiments about broader participation in dilution, which we will factor in to our considerations on future capital raising. I should add that there are currently no plans to raise further equity. Having strong, diversified funding arrangements in place with headroom is essential for our business, especially in this tightening credit cycle. Our funding portfolio includes bank funding from 2 banks, BNZ and ASB, bonds, which I'll talk a little more about, and a 40% equity component. 140 million banking syndication with ASB and BNZ was finalised in May this year and is now in place, and it provides adequate headroom for forecast business growth. In addition, the securitisation model implemented last year provides further growth headroom, and it reduces our overall costs of funds. Bonds have proven to be a cost-effective and successful source of funds, and we have had strong support from shareholders for this listed security. Pleasingly, 50% of existing bond holders have opted to convert into shares their bonds maturing in the next few days, further strengthening Turner's capital position. We recently announced a new $25 million 3-year bond to replace the existing program. Given my comments about equity raised last year and the sensitivity to dilution, we chose to offer more vanilla secured subordinated bonds with no equity conversion option and a longer term of 3 years. The $25 million issue will be fully subscribed. Our vision remains building an integrated financial services business, primarily focused in the automotive industry. We've defined strategies for growing our current businesses, and in addition, we're constantly looking for further opportunities to deliver higher and sustainable profits for the group. With relatively low market shares in our businesses, particularly in auto retail and finance, we're able to build through organic growth, including cross-selling, and where appropriate, additional growth through prudent and earnings per share accretive acquisitions. We've confirmed our profit guidance for this financial year through to 31st of March 2019 of a net profit before tax of between 34 and 36 million, the midpoint representing a healthy 13% increase over the last financial year. Turners has never been in better financial shape with a conservative equity ratio, an improved diversified funding platform to support growth with some headroom. On behalf of the board and management, I'd like to acknowledge our team of now more than 800 people spread across New Zealand and Australia for their contributions and for our performance and success. Despite opportunities, we operate in competitive markets, and attention, effort and skill are all required from our people to achieve our plans and forecasts. We sincerely thank you, our shareholders, for your continued support of Turners. We're very confident that sustainable and growing profits will translate into higher dividends per share payouts for all shareholders. And we'll be working diligently to try and correct what we believe is an undervalued share price. I'll now pass you over to Todd to talk in more detail about our performance, our progress, and some of the initiatives we have in place. We'll then be happy to take any questions on our presentations. Todd?
Thanks, Paul. Good morning, everyone. I'd like to start today just with a quick look back on FY18. I've talked to most people about this already, so we'll keep it relatively short. Highlights for the year included the successful integration of Buy Right Cars into the group and the merger of the 3 separate finance operating entities into the single business known as Oxford Finance. We also successfully merged Autosure into the insurance business, changed the company name to Turners Automotive Group Limited and dual listed on the ASX. As Paul mentioned, we also completed a $30 million capital raise to support our growth initiatives. These included the expansion of our property footprint, and we opened 4 new retail sites for cars and trucks and machinery, as well as the acquisition of a further 3 sites for retail development. Our property footprint has grown 8%, or 19,000 square metres in FY18, and we expect this to grow a further 22,000 square metres over the next 12 months with the projects we have currently underway. And as Paul mentioned, we also finalised the banking syndication with ASB and BNZ in May this year. That has been a particularly big project, taking over a year to bring to completion, and along with our other funding provides us with significant capacity to continue our growth strategy. The auto retail division remains the largest individual contributor to the business, generating 68% of the revenue and 41% of the operating profit. The acquisition of Buy Right Cars at the end of last financial year delivered a step up in results for that division. We took over management of this business in September last year, with the new management team asked to deal with some legacy issues around aged stock, which were impacting on performance. Pleasingly, we are now starting to see the turnaround that we expected, and we remain confident in the long-term growth prospects of the business. As we have discussed previously, the earn-out to the owners was reduced accordingly. The insurance business also delivered a big step up last year following the acquisition of Autosure, and together the finance and insurance businesses now generate more operating profit than the retail sector. And EC Credit Control continue to provide solid and consistent returns. Just a few comments on the market. There have been several one-off events which have impacted on the used vehicle market over the last 6 to 9 months. Firstly, there was the issue with the brown marmorated stink bug, which impacted on the flow of cars into New Zealand. Units of used imports coming into the country are currently down around 10% year on year, so that's August calendar year to date. Whilst stakeholders have put a lot of effort into resolving that issue, the success of these measures will play out over the next few months, in particular with the stink bug risk about to start again in Japan. We expect to see the increased cost of heat treating, which is the MPI solution to preventing the stink bug to come in. Every car needs to go into an oven effectively and go through this heat treatment process. So the cost of that heat treating and safely storing and transporting clean cars will definitely have a short-term impact on the margin, with those costs having to eventually flow through to the end consumer. But we believe this is going to place significant pressure, particularly on smaller operators in the market. Secondly, the compulsory Takata airbag recall has also affected the used vehicle industry. Cars cannot be sold until they have the repair certificates for those airbags, and in our experience, some manufacturers have been too slow to deal with the used import repairs in particular. The final event affecting the industry is the increase in fuel prices, and we expect to see smaller vehicles returning to favour, which inevitably impacts the pricing in both small cars and large cars. So small car pricing goes up and large car pricing will probably go down. For Turners Automotive Retail Division, we're able to draw on our variety of sourcing relationships, which has certainly reduced the impact of these events on our business. We continue to make excellent progress on our business objectives. We're very focused on growing market share by leveraging the strength and unique benefits across our integrated business model and offering more products and services to more customers across more channels. We'll still consider mergers and acquisitions where there is a strategic benefit. However, we see the majority of our medium-term growth being organic and coming from within the existing group. An essential ingredient to that success will be building on the trust element that Kiwis have in the Turners brand, established over more than 50 years of doing business in New Zealand. It's an incredible asset that we have within the group. The used vehicle market remains strong and the large number of end-of-life vehicles needing replacement continues to grow. As automotive sales increase, so does the demand for automotive finance and insurance products. We're targeting several key areas this year which will drive our growth. Within auto retail, we're putting the customer at the heart of all we do, with significant investments in training and people development, further investments into retail reconfiguration, and other ways to improve the quality of the customer experience we deliver both physically and online across all our businesses. In finance, we will be continuing the transition to higher quality and more profitable lending with a focus on improving our loan origination platform and our credit scoring decisions. We have a big focus on ensuring robust affordability assessments are completed at the point of origination and providing tools to assist our originators to do this. In insurance, we continue to develop new features on our existing products to increase customer choice and ensure these remain market leading, as well as developing new products for new risk classes such as electric vehicles. We also remain focused on being as efficient as possible and ensure we are pricing correctly for the risk that we are taking. In credit management, we're targeting growth from Australia in both the corporate and SME segments. Excuse me. We have a wealth of valuable data within our business that informs about our customers and the markets we operate in. In the automotive retail division, we have a huge amount of transactional data, so that's actual prices that actual cars sell for. In the insurance business, we have great data about which cars need repairing and how much we're spending on those cars. We have an enormous amount of data about purchasing habits, industry trends, and more. And we'll be looking to leverage this to engage with our customers, deliver better service, and identify new opportunities to do what we do better. Moving on now to each of our divisions, and given automotive retail is our largest business sector, let's start with that. Our goal is to be the retailer of choice for anyone wishing to buy or sell a used vehicle, be it a car, truck, or a unit of machinery. Our multi-channel platform ensures we are where our customers are, online, on Trade Me, or in our physical branches nationwide. At the same time, our finance and insurance offer allows us to meet all our customer needs at the time of purchase. Just a reminder, we operate under the two retail brands, Turners and Buy Right Cars, and we were involved in more than 50,000 customer transactions last year for cars, trucks and machinery, and damaged and end-of-life vehicles. The ongoing transition from wholesale to higher margin retail customers continues, with 70% of our transactions now with retail customers, compared to 65% last year. These sales provide us with more opportunities to sell finance and insurance products. In addition, the percentage of owned vehicles, so we sell through this business cars on behalf of people and cars that we own, the percentage of cars that we own has increased. So that's increased to 50% of the transactions, up from 15% 4 years ago. The cars that we own generate better margins and more finance opportunity. Organic growth is also coming from our damaged and end-of-life vehicle business, and we recently signed an agreement with another large insurance brand to dispose of damaged and end-of-life vehicles on their behalf. We've also introduced the Net Promoter Score measure into the Turners Cars business, and we'll roll this out throughout the retail businesses over the next year. The initial feedback is very positive, and this gives us a good benchmark to measure investments in the area of customer experience. Our website visits continue to build, and we believe we're in a clear second spot in autofocus web traffic behind Trade Me Motors. In another move, from the second half of this year, or actually from the first of this month, all loans originated through the Turners Cars business will be redirected into Oxford Finance. So that's a shift away from directing that business into the MTF loan book and into the Oxford Finance book. This will see approximately $4 million a month being written into that Oxford business, with the benefit to the wider group of more margin and an increase in fee revenue. The development of our national network continues to be a priority, both in expanding our footprint and relocations and refurbishment of existing premises, as we keep moving that Turners business from a wholesale auction-focused business into more of a retail-focused business. This opens up additional, ongoing and repeatable opportunities for profit contribution. While the number of customers researching and buying online is growing, the majority of buyers still prefer the in-person experience. Being able to view different cars on offer, take them for a test drive and buy in person remains the preference for most people. Ensuring we have retail sites in strategic locations across the country, we believe is a significant advantage for our business and will be a key enabler of growth moving forward. When looking at new sites for both our cars and our trucks and machinery business, we consider a number of factors that determines whether we acquire the site, lease it, or buy it and then sell with a leaseback arrangement. This allows us to secure strategic locations and develop the site to suit our needs. We currently have 25 Turners sites across cars, trucks and machinery and damaged vehicles, and 11 Buy Right Cars sites, and we'll continue to invest into new sites, relocations and refurbishments to ensure we are in the right places and can offer the best possible customer experience. Having our own retail network also opens up additional opportunities for that profit contribution from the sale of those finance and insurance products. Since the start of the year, we've relocated our Wellington branch to Porirua. We've extended and developed our own existing Napier site, acquired land for 2 further relocations in Whangarei and North Shore, negotiated a new lease on a site in New Plymouth, which is a new market for the business, and we're developing a Turners Cars retail site in Wellington City. And we've also opened 2 new Buy Right Cars sites, one just around the corner here and one in Hamilton, which is our first expansion of that brand outside of Auckland. We think we have a pipeline of 5 years plus of property opportunities ahead, including large projects in Auckland and Christchurch. And we plan to access capital out of the insurance reserves, and we'll recycle that pool of property capital regularly to enable further projects to be taken on. It is estimated that more than 80% of used car buyers require finance of some kind. Similarly, the majority of buyers will need insurance cover. Turners provides for this, offering a range of finance and insurance products through our own retail channels, but also through a network of more than 1,500 dealers and brokers throughout New Zealand. So we sell those products through our own captive channels, but through that group of independent dealers and brokers through the country as well. The market is very competitive, as you'd imagine, but we're continuing to experience growth as we focus on delivering faster, better and easier solutions for our customers. This resulted in our finance book growing 39% last year, and we've successfully merged the 3 operating finance companies into one entity and put significant investment into our loan origination platform to make it easier and faster for dealers to load applications and get a credit decision. Things like electronic ID verification and address verification significantly speed up the process and have improved the overall customer experience. We are focused on high quality lending, and impairment levels from the MTF channel have been higher than anticipated, and we've introduced stricter lending criteria progressively across the last 12 months. That has significantly reduced the volume of loans we are writing through that channel, but we have improved the quality of that business. We continue to work closely with MTF to explore ways of rebuilding that volume, but at an acceptable quality of lending. On the theme of quality, that's also an important focus for our insurance business, and we've recently completed a review to identify further opportunities for claims efficiencies. We believe we can reduce the cost of our insurance operations through the use of fintech and streamlining our processes. We also continue to look at data analytics to ensure we're pricing correctly for the risk that we take. We're also pleased to have AM Best, the world's oldest and most authoritative insurance rating and information source, recently reaffirmed DPL Insurance's financial strength rating as B+. A few comments about some progress in finance and insurance. So we've made some really good inroads around improving the quality of lending by tightening that lending criteria. You can just see some information there on the slides. The enhancements we've made in the loan origination platform have enabled us to win more customers. The finance company have brought on 100 new dealers so far this year, and we've planned to introduce comprehensive credit reporting in the second half of the year, along with some automated affordability assessments utilising customers' banking data. Our repricing work in insurance continues to happen at both a product and originator level. We've increased the pricing on a significant number of vehicles and implemented customised price increases for higher risk dealers. So that's making sure that we get the right return for the risk that we actually take. Our replacement for the insurance system has started, and this project will be completed by the end of this financial year. In credit management, EC Credit Control offers total credit management services for its customers in New Zealand and Australia. It is a solid and consistent performer, delivering great cash flow and profitable returns, and has been part of the Turners portfolio since 2012. We believe Australia remains a major opportunity in this business, and we're investing in senior sales expertise to acquire new corporate customers in this market. We are doing exceptionally well in New Zealand, and we feel Australia has plenty of room and opportunity for us. Our corporate debt load continues to grow nicely with some new customers coming on board, and we're growing share from our existing customers. Our SME product sales are tracking extremely well. We're very excited about what we can do with data to help improve results for our customers and our own efficiency. We can now generate a collection score for debtors based on data we have, such as address, gender, age, contact points, and past experience with EC Credit Control. What that allows us to do is prioritise those debtors who are more likely to pay. So we focus our efforts on those customers that are more likely to pay their debts back. We've also driven some efficiency in our operation with the implementation of the dialer technology. In the first 6 months of this year, we've increased outbound calls, SMS text and emails by 95%, and actual customer connects by 20%. So you can see that dialer technology just enables a whole lot of stuff to happen automatically in the background without having to have people do it, which makes our business much more efficient. This business is in excellent shape with good growth opportunities ahead of it. We will continue to do the same things well, building the customer base, building the share of debt from existing clients, and enhancing our analytics capability. We are coming to the end of the first half of the financial year, and after what was a reasonably challenging first quarter, we've seen a pleasing turnaround in trading within Q2. We've also made a number of investments in people and property which will deliver benefits in the second half. Turners Group is in line with budget expectations, whilst Buy Right Cars' turnaround has taken slightly longer than we anticipated. However, we are seeing positive momentum in the business. Finance is currently tracking behind our expectations, mainly due to the arrears performance in the MTF lending. However, we expect to see some positive counters to this as we see the benefits from the Turners Cars lending in the second half. Within insurance, the team are doing a great job of winning new business and building growth and premium through repricing and managing the claims costs. We expect to see improvement in H2 as initiatives deliver, and we realise some property gains as we recycle that property capital to apply to new projects. EC Credit Control performs in line with expectation. So for the full year, we are still very much expecting to deliver a net profit before tax of between 34 and 36 million. Whilst we've had a few challenges with buy right cars and the performance of that MTF loan book, we can see improvement in our monthly results, and our confidence in our guidance and our long-term prospects remain at high levels. Thank you very much for listening today, and I'll now pass you back to Paul.
Thank you, Todd. We'd now like to invite questions, initially in relation to either the annual report or to today's presentations. And there'll be an opportunity to ask specific questions about each resolution as and when they are put up to shareholders for vote. I may ask Todd to help respond to questions on operational issues, and I'm sure Aaron will provide much sounder responses to queries on any matters included after about page 6 of the annual report than I might be able to. If you have a question, could you clearly state your name, and if you're a shareholder, state your name, and if you are a proxy holder or corporate representative, please state the interest you represent. So are there any questions? There's a mic here.
Yes, good morning. My name is Kevin Knight. I'm a shareholder who lives in Hamilton. I appreciate what you have delivered today, Mr. Burns and Mr. Hunter, at a fairly high level, and I value that. I feel that the Australian arm is not going as I would have expected. The only reference to Australia, I believe, was when Mr. Hunter said, "We feel there is growth prospects in Australia." What assurance can you give us today that, in fact, there are strategies in place to make Australia succeed at a better level than perhaps other organisations like Warehouse and others who've moved into Australia and failed? Thank you.
I'll just make the comment that we're very happy about our Australian performance, but I'll hand over to Todd perhaps to provide some detail to support that.
So about 50% of the about 50% of the EC Credit Control revenues come from Australia. Largely they come from the SME business that we have over there. So we have around 50 commission-only salespeople selling terms of trade products and debt collection services to SMEs. Where we've struggled with traction is around the corporate business. So where we're very successful in New Zealand in that corporate space, we've really struggled to get traction in Australia. So things that we've done differently or that we're putting in place, we've freed up the CEO around some of the time that he has to spend more time there. He is the best guy to be attacking that market. We've changed out business development resource. So we had quite a long-term guy who was working for us over there. We've changed him out for a new guy. We've put an additional resource into Melbourne. So we now have 2 dedicated people, one in Sydney and one in Melbourne, plus the CEO spending significant time over there. So, look, we think those are the right strategies to help speed up the traction that we're getting. Time will tell. But the initial indications are positive.
And these really are to take advantage of opportunities we see there, not to correct performance that's of any concern. In fact, August was an absolute cracker month for EC Credit. I think the best for some time.
Yeah, absolutely.
And Australia made more than its fair share of contribution to that result. Are there any other questions?
Mr. Chairman, my name's Alan Best and I'm a shareholder. I just wanted to get a little bit of clarification on a couple of things that occurred in the report. First of all, what's the nature of the partnership with Super Shopper? That's a service organisation. Is it mechanical service, or what's the nature of the part?
Yeah, the nature of that partnership is that we are reselling service plans for vehicles. They provide the service. Yep. So all we do is take a product that they sell today, package it up under what we've branded Turner's Auto Services. They provide the service. So I guess it's an agreement to supply their services in this business.
Yep. The other next question I have is, I wondered what the loss ratio is. We're talking about the credit cycle.
Yep. And
how do you gauge that? It was 70% in the annual report.
Yep.
What is it exactly?
Well, that's the combined loss ratio across all the different insurance products that we sell. That's right, isn't it? Yep. And I mean, we're measuring that almost on a daily basis. It's one of those things that it takes some time to bring down because you've made commitments under policies to fix certain things. So we're working very hard around the efficiencies that we can build into our claims process. There are things we're doing around parts costs. It's around the cost of labour. So wherever we can save ourselves a dollar, that dollar drops straight to the bottom line in claims. It's not about stepping away from our responsibilities around actually owning up to a claim. It's how can we make the process more efficient.
In the acquisition of the insurance business, there's a bit of time spent in the annual report on life insurance. But what percentage of the insurance business would be automotive? Because that's much more diverse.
It's probably 90%.
Right. So life insurance, in fact, is a very small component indeed.
Yeah.
That growth from 8.7 million to 39.7 million in premiums is tremendous, and I mean it's been the secret of success in a number of big overseas concerns. So the shift of capital from that source into development has to be monitored very closely because you still need all your reserves.
Yes. Yep.
Do you have the necessary scrutiny on that?
Gee, I might hand this over to the chairman of the insurance company.
Yeah, look, I'm absolutely delighted to answer that. Yes, we have a basically what we do is we have we monthly look at our capital and our use of capital within the insurance company. So I think when you have lots of reserves, because you have lots of future claims or lots of expected claims, those reserves in most companies often sit there and they're put in a cash account where you get a very, very low return. We have very, very active management of our reserves. So we've referenced the property purchases within the life insurance reserves. We hold a RAM book within that reserve as well, and our yield on our reserves is actually probably one of the highest of any insurance company I've ever worked in or worked for. So we're constantly looking at the best way of using that money in there. When we talk about the loss ratios, I guess I wanted to make a little point about that, is that it is a ratio. So the bottom line is the premium that we get in. We know when we acquired Autosure, they actually hadn't had a price increase on any of their policies for near on 3 years. So we basically inherited a group of policies that we have the obligation on, that we've had to look at and say, how is this performing? So our deep dive, I guess, into data, into looking at the originators of the insurance policies, finding the good ones, finding the bad ones, actually finding which cars cost us more money and which don't. We've actually done a huge amount of work to actually reprice that whole portfolio and try and get that denominator a whole lot better as well. When we look at the claims side, as Todd mentioned as well, there's a lot of work going on as how we can be more efficient. Now, the insurance industry generally around the world has a reputation of not paying claims, but that is not where we want to be. We actually have an obligation, but we know that some of our claims are fraudulent. We can look at our data to find those. We know we are gamed at times where people do enhancements to vehicles and call it an insurance claim. So as we use our data and we get better relationships with our providers, we can actually bring that loss ratio down over time. So we are looking very, very hard at our data, at our processes, at our systems to actually do a better job than we've ever done before.
Thanks very much.
Might be worth just adding that insurance is a regulated industry. The Reserve Bank of New Zealand are the regulator. We must have and do have a consulting actuary who looks at our monthly results. He's very conservative, if you ask our management, because he has to sign off a 6-month position report that goes to the Reserve Bank to confirm to them that, in his opinion, our reserves are adequate. So we are under quite good governance scrutiny. Sorry, I'll take your... this gentleman first here.
Yes, thank you, Stan Googe. I'm a shareholder. We're celebrating the 125th anniversary of women's suffrage. You say some corporates don't look upon us as well as they might, and I wonder whether that's because of our all-male board. I know in motor vehicles there are a lot more interest from men, from ladies, but what are you going to do about your board whole?
What we're going to do is to make sure that our board has the diversity of thinking that is appropriate and provides the best result and the best oversight and assessment of our risks. So we have a diversity and inclusion policy, which I happen to have here. And it has had a lot of discussion. I think the interesting thing is that there's some diversity amongst the board as to what the diversity policy should be, but that's all healthy stuff. We're committed to a culture that actively supports diversity and inclusiveness and prevents or eliminates discrimination in any form. But there is an overriding policy that the board has agreed, and that is that at every level we want the most talented group and talented individual for that role. So we're very active in encouraging gender, ethnic, but we don't think it's the right decision for shareholders to appoint other than the best candidate. When you talk about diversity, I think there was an interesting article from Mei Chen that some of you may have seen, and basically, if I can find the quote, the point she was making is that it's a bit simplistic to assume that gender or ethnic or age appointments necessarily produces more diverse thinking. It's interesting if you look at the background to our board and the diverse nature of their backgrounds. I mean, I won't sort of go into it, but starting with Grant, I mean, Grant's been in office products, he's been in power company, build up and sale, he's been in 42 Below Vodka, and his most recent venture trilogy, all very successful. Matt, who's not with us, had a lot of time in the transport courier industry and then started EC Credit, building it into Australia. We've got John. John spent 10 years in the advertising agency Saatchi & Saatchi. That's pretty creative stuff. Before he joined Vader, I think before that he had a stint at MasterCard. All right, John? Anthony's actually a doctor and a GP, was a doctor and GP. Quite a different approach before he moved into health insurance and then general insurance. Alistair comes from the agri sector, international marketing, international sales. He's a shareholder in a startup egg and distribution. John's a shareholder in a startup fruit juice. Who have I missed? Martin, you'll hear from. Great diverse sort of background, and you'll hear from my background later as well. So look, we are conscious of, if you like, this current issue, but the focus has got to be on ensuring that we get diverse thinking to challenge, to look at issues, to look at opportunities.
Thank you, Mr. Chairman, for those usual words. The answer to the question is, what are you doing about a female on the board? And the answer is nothing.
We won't be appointing a female on the board if the candidate in front of us at the time is not a female. So unfortunately, you don't agree with that policy, but that is a policy that this board will be following.
Are you engaging in a search for a suitable candidate?
We are making no difference on the search as between gender or ethnic or age. We just want the candidate that is going to give us the skills that we feel may help us at the time. And the last time we looked at it, we found Martin, and we think he will add to those skills and round out, and hopefully you will agree when you vote for him and hear his background. So thank you for your question. Is there any more questions?
Thank you. I'm Bruce Parks, a shareholder. Your provision for impairment expenses has gone up quite a lot. Could you comment, please?
Todd, do you want to?
Yeah, so I was standing up. I mean, it's fair to say that our sense is that the credit cycle has turned a little, and the people that we lend to are generally people who don't own their own home, and those people have been subject to much higher, I guess, costs or inflation pressure than perhaps has been reflected in wage and salary increases up till now. So at the higher risk end of our book, impairments have definitely ticked up. And the steps that we're taking are to limit the lending we do at that risk, at those higher risk levels. So, we expect over time that will normalise. We also expect that with the government that we currently have, typically that government is very supportive for our core customer base. So with state support of incomes and things like that. So our sense is, and there's some research actually out of the States, that when minimum wages rise, car sales actually go up because a bunch of people who couldn't afford a vehicle now can, and it's the same with essentially lending to those people to buy cars. So it feels like there is a bit of an affordability situation existing for people in the lower, I guess, socio-economic category. We think that will change over time, but we are cutting back our lending to some of those people now. Yep.
Sorry.
Hello, my name's Gavin Parks, and I'm an investment manager for a private entity that holds an interest in Turners. My question's relating to the ASX listing. You briefly mentioned it as an overview from last year, but I'm wondering, has it met expectations? If not, why, and how much did it cost?
Well, let's get the cost thing out of the road. How much did it cost for us to list in Australia?
There's like a one-off initial fee of just under 200,000, and then an ongoing fee of around about $60,000 a year. Yeah.
So it probably hasn't met our expectations, but we believe there's probably close to 5% of our register owned by Australian institutional and private shareholders. And why we can't be more accurate is because a number of them buy through entities based here and trade on the NZX. But they wouldn't be allowed to do that under their mandate unless we were dual listed. So, I mean, the transactions or the liquidity on the ASX is not the issue. The issue is to try and have a larger potential support base for shareholders in the future. So Todd and Aaron and Grant have spent some time in Australia, because you can't just rush over there, as you will appreciate, and expect them to fall in love with you and buy your stock. We'll continue to do that. The ongoing cost of the listing, as Aaron pointed out, is $60,000. It's neither here nor there. And the support and the interaction we have with those Australian institutional and potential institution is quite helpful. So I would say we're a little disappointed, but we would probably make the same decision. And given it's a sunk cost, and we have now got a base of Australian shareholders, we'll continue to work at that and grow that base.
So that's an expectation this year to work and grow it?
Well, we'll be visiting more. I mean, it's their decision as to whether they buy more stock. Hopefully they're listening to us about the current undervaluing and rushing in there in short course. But yeah, we'll be working at it.
Okay, thank you.
Can I just add a comment? Gavin, I mean, to me it's about, there's a number of institutions over there, about 25% of them have an NZX ASX mandate. So we've broadened our possible shareholder investment pool by undertaking that listing. And as Paul said, at 60 grand a year, it's kind of neither here nor there now. We just need to keep our presence up and keep busting the doors down and keep having meetings with people over there and just maintaining a presence, which is what we'll do.
Hi, I'm Roger Clark, shareholder. Just want to get a little bit more colour around what's happening with these motor trade finance problematic loans in terms of, are we seeing any improvement since the new families package kicked off for low-income families from the 1st of July?
Yep. Look, if we kind of look at that from when we first started it, Roger, we've made, I think, 4 changes to the lending criteria as we got to understand how that book was seasoning. I mean, since July, we've really written very little business through that channel, so it'd be difficult for me to really comment on have we seen a noticeable change because of the government benefits that have come into play. I guess we work the loans hard that we've got from a collections point of view. I guess we've had, or we've seen some improvement around the arrears and the collections efforts that we've been putting in and the returns that we're getting from that. So it feels like the book has stabilised, and we continue to work with NTF around how we get back to writing good quality business out of that channel. I mean, fundamentally, it's going to take a change in the process. I mean, the issue we had was we were really too reliant on the NTF lending platform, and we weren't able to see those loans directly ourselves at enough layer of detail. So, sort of pitch forward, that's how we need to do it. We need to have those loans coming directly into us. We need to work with NTF how that's going to happen.
So on a weighted average basis, Todd, how long is that book in terms of the average loan? I mean, we're looking at some problematic issues in terms of recoveries. Yep. And how long can we expect these sort of advanced levels of delinquency, if you like, to be a problem going forward?
We think probably another year or so.
Yeah, another 6 to 12 months.
Yep.
So the average seasoning of those loans is sort of somewhere between 12 and 15 months now, and their average effective life is somewhere between 18 and 21. So that gives you sort of an idea of where we've got to before it's a fully seasoned book.
But I guess the other thing to remember, Roger, is that we were making improvements around that lending criteria all the way through. So, theoretically, you kind of get through the worst, but then it should improve.
And the analysis that we have done, looking at loans written from the date that we made changes, reflects improved arrears. So, look, we initially mispriced, and our lending process, or the lending process, wasn't good enough. We moved quickly to fix that on a number of these changes. We've got the provisioning under control, but we can't say, that it's all fixed, because it will take the time that Aaron said, but we wouldn't expect to have a surprise adverse impact on profit as a result of the loans that we've already got on our books.
Thank you.
Peter Bradfield, shareholder. Did we get a reason why the chairman of the company isn't here today? I thought one day a year he'd...
Yes, Grant Baker had a long-standing arrangement to go overseas, and for a number of reasons we shifted the date of this meeting, and it then meant he was unable to attend in person.
Quite disappointing.
I'm sure he's disappointed that he can't be in attendance as well.
Did you not say he was remoting this?
Yes.
Yeah, he's in attendance.
Don't see him on Skype.
He's on audio link.
He can talk. Grant, would you like to confirm you're there?
Yeah, look, I will confirm I'm here. I hope you can hear me.
Yep, it's fine, Grant.
Yeah, okay, thanks.
I feel that's really quite unacceptable to have the chairman listening in and saying nothing. I think maybe a word at the beginning of the meeting, apologising for his lack of presence, giving us a reason, and then saying he's listening in would have been a much better proposition than the situation we're faced with now, where suddenly he's speaking to us.
Well, I'm sorry if you missed my announcement at the beginning that they were remotely joining us. For practical purposes, it just doesn't work if a chairman's not in person to chair the meeting. And I guess it's an indication that there's a good consensus amongst the board. I mean, the issues have been circulated, the addresses have had comments from others, including Grant. So it's just unfortunate that the timing, which was not entirely of his making because we changed it, meant that he couldn't be here in person. Are there any other questions?
Yes, Edwin Stranahan. I'm a shareholder in the company. A question, several that I wanted to ask, or points, please. The first one relating to the insurance. As far as the insurance is concerned, do you think there's a branding problem? I mean, are you deliberately trying to just restrict your insurance activities among customers? Because I think most people, if they're looking to, say, get quotes on insurance when the insurance policy comes up for renewal, the two that come to mind, AMI and state, and of course if you accidentally stumble on television you might get on the Huey, but is it a branding problem? Do you want to try and sort of expand into the wider community?
Well, firstly, it's not a branding problem. The AutoSure brand has been around for 25 years. It's a brand that's sold through dealers, so it's not a brand that we sell direct to consumers. So we are not you're not ever going to see that brand on television or probably alongside the likes of State and AMI. Neither are we in the market of comprehensive motor vehicle insurance. So we are very much a niche insurance provider. We in fact got out of comprehensive motor vehicle insurance when we purchased the Autoshore business. That was part of the deal we did with Vero, and quite frankly, that was one of the best moves we ever made, because making $1 out of comprehensive motor vehicle insurance is very, very difficult. And even the scale guys are having trouble making money in that business because the costs are just increasing at a rate which their premiums are not aligned with. So I think for us, our business remains very focused around mechanical breakdown insurance and the other sort of loan repayment and payment protection insurance products that we typically add on when someone's taking out a loan.
The other one relating to the insurance side, I noticed, for instance, premiums are going up and the coverage is going down. Coverage going down, I'm referring specifically to where you get the no excess applicable or no claim bonus in respect of glass. I live on a busy road and rear vision mirrors are, just about one a week there, and a rear vision mirror on one side usually. One person I heard got a shock when they heard that was between $700 and $800 for a full unit, or about $250 to $300 just for the glass inside it.
Yeah.
Do you sort of look and what's your attitude as far as that glass side is concerned? I mean, the other part really is windscreens, where there's an increasing number of sensors in the windscreens, and so they're no longer being covered under the no excess rule or no claim rule for claim on glass.
It doesn't really affect us because, as I said, we got out of the comprehensive motor vehicle insurance business. All we do now is resell a Vero product. So we just take a commission for every product they sell. They take the underwriting risk. So the things you're pointing out are the exact challenges that those big insurers have. More and more technology is being built into wing mirrors and headlights and windscreens, and the cost of replacing and repairing those components on the cars is getting more and more. So that's their challenge. We're out of that business. So we typically, we're slightly more insulated around those things than they are.
Yeah. The other one was in connection to the activities in the finance sector, particularly in relation to motor vehicles. Are you sort of tending to look and concentrate on what people are doing now who are competitors, or are you looking at also other ones who are perhaps even made public what they're proposing to do? One I'm thinking of in particular is Heartland Bank. They've just reorganised themselves with a major vote. And I mean, their words, not mine, so there's nothing defamatory. They said that their reason for this is they can get around Reserve Bank of New Zealand regulations in respect of activities in Australia, and that they're going to target more into the automotive finance sector in both countries. Do you sort of try and keep up to date with a competitor like that who is proposing to go into something that is in direct competition with you?
Yeah, I mean, we obviously monitor our competitive landscape constantly across all the different businesses that we operate in. And I mean, we do operate in very competitive markets. Automotive retail is a very competitive market, 3,500 dealers. Same with finance, insurance and credit management. So I mean, we're constantly surveying that landscape. I mean, in the finance sector in particular, we think we're gaining share. So we've made some great advances around our loan origination platform. We were probably behind the 8 ball 12 to 18 months ago. We feel now we're getting ahead of the game, and we are signing on more dealers and we're writing more business. So we are absolutely taking share. So yes, we keep monitoring them and we feel like we're going pretty well. It doesn't mean we're going to sit back. I mean, I think we will continue to put investment, particularly into those digital assets that we've got, because that is where our fundamental proposition will end up winning.
Thank you. Unless there are any further questions, perhaps we could move on to the resolutions. These were notified in the notice of meeting and the explanatory notes have been provided. Voting on each of those resolutions will be by way of poll. At Staples Rodway, the company's auditors will act as scrutineers. So please use the voting papers you received in the mail or were given when you registered for this meeting. Don't panic if you haven't got a voting paper. You'll be able to request one from the scrutineers and when voting takes place. Just a reminder, only shareholders, proxy holders and corporate representatives of a shareholder may vote on today's resolution. The first resolution is to record the reappointment of Staples Rodway as auditors of the company and to authorise directors to fix the auditor's remuneration. Are there any matters for discussions from the floor on this resolution? If not, I'd like to move this motion. Could I have a seconder? Thank you. And so the voting will happen at the end of when all the resolutions have been put. The next three resolutions are in regards to director appointments. We believe, as we mentioned before, having directors with relevant industry, commercial, governance and diversity of thought in particular, broader commercial acumen should all be taken into account when reviewing board membership. And as I mentioned, we've currently got directors with hands-on experience, not only in the finance, insurance and debt management sectors that we're focused in, but diverse experience, entrepreneurial skills in sales, marketing and business growth and business turnaround. The most recent appointment to the Turners board was Martin Berry. Martin's a seasoned global financial services executive and entrepreneur. He's run large international businesses for the likes of ANZ, Citibank, Barclays, Standard Chartered. And more recently, he's focused on entrepreneurial ventures. He has a very successful track record of having built, acquired and sold several companies with values in excess of $100 million US. He later founded, he now runs a venture capital firm, Brownhouse Capital Partners out of Singapore, investing across the region with a strong focus on fintech. So the technology and emerging opportunities focus Martin has. He has networks and business relationships through Pacific and through the Pacific and Asian region. So we are very confident that Martin's experience in that financial services sector, combined with his entrepreneurial acumen, will be a real asset to the group. Resolution 2 is for the shareholders to consider the election of Martin as a director. So I'll now ask Martin to come up and say a few words in support of his election.
Thank you, Paul, and good morning, everybody. I'd just like to start by saying it's a great opportunity to spend some time with you this morning, and it's really nice to be here. What I'll do is just quickly touch on a bit about my background, my experience, and how I'm looking to leverage that to add value to the Turners Group. I think Paul covered quite a lot of it, but the bulk of my career has been in the financial services industry, working for some of the largest banks in the world, working on a global basis, working basically in 7-8 different countries. The biggest job that I did during my banking career was that I was the global head of consumer banking for Barclays. I was responsible for about 40 countries around the world, a multi-$100 billion balance sheet. And over my financial services career, I've garnered a lot of experience when it comes to running big, large credit portfolios, especially when it comes to consumer and retail lending. So how I'm looking to leverage that experience is trying to bring a lot of innovation that I've seen in large institutions as well as in more advanced markets around the world to add value to Turners business, as well as has been talked about, a key concern in any credit business is the cyclical nature and the volatility of the earnings. The economy has been reasonably good for quite some time. That's not always going to be the case. So bringing a lot of experience around risk management and how we optimise for the credit cycle is another area I'm looking to add value to the organic business. As mentioned, I then went and pursued some entrepreneurial aspirations. Subsequently, I started a company, and in the space of 3 years, I went from sort of 0 to 400 retail outlets, doing about $100 million in revenues, and I subsequently sold a majority of that company to a private equity firm. So I have quite a lot of experience in terms of entrepreneurialism and setting up, running and selling retail businesses. Finally, as Paul touched on, I spend a lot of my time these days running a successful venture capital fund. So I'm investing in sort of early stage companies with the theme of disruptive innovation. So that's everything from looking at, electric vehicles, autonomous vehicles, looking at things like fintech and how, new innovations in fintech can be brought into older legacy businesses. And so this purview of having, a lot of experience and exposure across Asia, being based out of Singapore, hopefully will give me an opportunity to bring new thought leadership and bring some innovative ideas to the Turners business on growth opportunities going forward. So that's all the positive stuff. The one potential negative, I'm Australian. But please don't hold that against me. But, I'm really looking forward to joining the team here. I think it is a great team. I'm hoping to inject some new energy, some new thought leadership, and I look forward to working with you all. So thank you very much.
So other than his ethnic origin, are there any questions you'd like to put to Martin?
Sure. Where are you based? I'm based in Singapore. Yeah, so I'm based in Singapore, but I probably spend, I would say, 60 to 70% of the year travelling throughout the region, meeting companies, investing in companies. And my plan is at an absolute minimum to be here for at least the quarterly board meetings. But with technology now, it's quite easy to dial in and do it remotely as well. Yeah. Any other questions? No? Great. Thank you very much. Thanks, Paul.
I'd like to move this motion. Again, could I have a seconder? Thank you. We'll vote on that at the completion of all resolutions. Looking now at resolutions 3 and 4. Under the NZX listing rules, 1/3 of the company's directors must retire by rotation at the annual meeting. This year, Anthony and I retire by rotation, and being eligible, offer ourselves for re-election by shareholders at this annual meeting. Anthony, who you've heard from, Anthony's been a director and chairman of Turners Insurance Company, DPL, now Autosure, since 2012. Anthony's a highly experienced insurance industry professional. He has demonstrated success as a senior executive consultant in insurance and wealth management businesses within Australia and New Zealand. Anthony brings a hands-on, I was going to say bedside manner, but he doesn't actually, practical commercial approach, plus strong technology focus to his role. His relationships across the industry and the regulators is highly valuable to Turners. Sometimes those informal discussions are really helpful. And his collaborative approach is embraced by both board and management. We certainly have hands-on chairman. So I'll ask Anthony to say a few words in support of his re-election.
Right, good morning all, and thank you, Paul. I welcome the opportunity to be considered for re-election and continue to contribute to the Turners Group Board of Directors. It's been an absolute privilege to be an independent director on the main board for the last 3 years and chairman of the insurance board for the last 6 years. I think a good board has very diverse voices, and that's from visionary entrepreneur to calm rationalist. And I would say our board actually has them all. So it's been my good fortune to work, I guess, with such a dynamic, dedicated board and management team. They've nurtured and grown this company over the time I have been involved, and that's evidenced by another good year of results. The last 15 years of my professional career, I guess, has been dedicated to realistic transformational change in the finance and insurance industry. And that's from things like championing customer focus to developing new channels for business and new ways of doing business. I have a current executive leadership role in one of Asia and North America's top 3 insurers, and that role is responsible for digital transformation of both the wealth and insurance customer journey. Added to that, I have a second-line risk role in Asia where I look after the risk function for an organisation and also maintain and create superior returns, which is another one of my KPIs. Balancing that with risk and digital transformation is very interesting. I want to bring these skills and continue to bring these skills to support creating further organisational value for Turners. My commitment to this is I actually return to New Zealand every month for board meetings and to spend time in our businesses. And I will continue that commitment if re-elected. So thank you again for your consideration. Any questions?
Anthony?
No, I would say my health background does bring one thing, and that is actually a focus on people. So I'm very keen on actually being able to understand the behaviours of our customers, the things that drive them, the things that actually for us to bring value to their journey with Turners. And, you know, I absolutely champion that part of the business.
Thanks, Anthony. I'd like to move that motion. Again, could I have a seconder? Thank you. Cheryl? The next resolution is in regards to my own election. So I'll shortly hand the chair over to John to chair that part of the meeting. But before he does come up, perhaps I'll give you my background. I have a commerce background and a commerce degree majoring in econometrics. I have a CA qualification which I've never used and will never use. Rather, my career involves senior management and CEO roles across a number of industries, often with turnaround management situations and participation in merger and acquisition opportunities. Earlier in my career, I effected a management buyout of a listed but poorly performing Wholeproof Industries, which certainly gave me a taste of the value that can be created in turning businesses around. I was a major shareholder in a startup company, Prism Software, which we expanded into 3 countries before selling out to a NASDAQ-listed software company. That was a 8-year journey. I was also a minority shareholder in Navman before the sale to American interests. I've been an angel investor as Martin is, a number of startups, and I still enjoy providing mentoring on a voluntary basis. My involvement with Dorchester commenced actually as an independent director representing the interests of the late Hugh Green. I then stepped in to help Dorchester, which was facing the same failure as many other finance companies in the global financial crisis. Initially, this was on a consulting basis, but I subsequently stepped in and led Dorchester as CEO and executive director through the recovery and through a significant growth via acquisitions. They included, as you're aware, EC Credit, Oxford Finance, Turners Auctions and Autosure. I handed the CEO reins over to Todd 2 years ago. My other governance experience includes 10-year plus terms, director of listed Halliby Holdings, and as chairman of Top Energy, which is a power and generation company. I was, for 3 years, guest lecturer in corporate governance at Massey University. I might add that was the Albany campus, given recent politics. That was for their MBA and Stage 3 corporate governance papers. So I provided examples under Professor Vanderwalt for some of them which were published. So real live examples. Interestingly enough, at that time, one of them was Dorchester as an example of very poor governance. That has since changed. I'm conscious my term on the board now exceeds the nominal 3 terms of 3 years, so 9 years. So I do consider carefully whether my knowledge, skills, governance experience is still adding value. I'll always be happy to stand aside as part of any board refresh, just as I proposed, and I promoted the handover of my CEO role to Todd, and a very good job he's doing as well. In the meantime, I'm confident I can add value. I have the support of my fellow directors. I believe I have support from institutional shareholders that I've worked with over the years. I'd appreciate your support for my re-election. Thank you.
John.
Thank you, Paul. So as Paul mentioned, the board unanimously supports Paul's re-election, and I think a lot of you who have been shareholders for some time will actually recognise the hugely valuable support and the contribution that Paul's made to both the Dorchester position and more latterly to the Turners Group, because he was instrumental, along with others, in actually rescuing that company through the GFC, and as we all know, a lot of them did not get to where they were rescued, which was not great. And you now have a substantial company today with your capital intact. Also, Paul holds personally 4.44% of the capital of the company personally, so he's not only emotionally but also financially committed to the growth of this organisation. So before we move the motion, does anyone have any questions for Paul? No. Okay. Well, I'd like to move this motion. Do I have a seconder? Thank you very much. I'll now hand back over to you, Paul.
Thank you, John. The final resolution today is for shareholders to consider an increase in directors' fees remuneration to $665,000. The last increase was approved by shareholders 3 years ago. This increase, and it's a significant increase, allows for the appointment of Martin as an additional director. The board engaged Strategic Pay to review director remuneration against market standards to ensure that our directors and new directors receive remuneration which reflects the time and experience that they contribute. The review considered the current position of Turners, which is markedly different to the position of the company 3 years ago. Turners has doubled and trebled total assets and sales revenue since those fees were set. It's always a little bit difficult, a resolution like this. If we don't say anything, we're accused of not justifying the increase. If we do say something, it's sort of self-serving. So in the interests of at least serving other directors, I'd just like to make the point that the strategic pay was, the usual prescriptive exercise based on assets, profit, turnover, and I think we picked the midpoint of their suggested range that they felt was market. What I think didn't sort of come out was the makeup of that growth in the last 3 years included some quite significant acquisitions. So, for example, Autoshore, we acquired that. It's now a significant contributor. Autoshore was owned by Vero, Suncorp, a very large company, and it had its own governance structure through the corporate, and a lot of people, as James will know, in Vero and Suncorp had an involvement in the governance of Autoshore. Now, we have to take that over, and it's a bit different to, let's say, growth from a receivables book when it's just more of the same. This is a different industry, this is a different company, and the time involved in that additional governance work is not insignificant. And the same would apply to Buy Right Cars. It had its own governance, it had its own board. I would very conservatively estimate that the time commitment just on these acquisitions is about 40%. And I know for a fact that our board meetings, which used to be able to finish at 2, don't finish at 2 because we have these other factors, and we also have a lot more visits of the board and board meetings in the various sites. So that time commitment is quite considerable. So the growth, including the acquisition, I think has to be taken into account. Based on the market review and those comments, the board considers that the proposed increase will result in appropriate but not excessive level of director remuneration. And just before I take questions, could I just note, I'm sure most of you are aware that directors can't vote their own representative shareholding for this resolution, so we are in your hands. Could I take questions?
I believe the time is not right for an increase of this magnitude. I think there's a galaxy of talent in the board. I think we're lucky to have Mr. Byrne here today. Burns, I go back to Dorchester when I got involved, and I know you're a humble man. I know you've got highest integrity and also very, very capable with fiscal prudence. I feel that we learnt enough in earlier dialogue today that there is still some areas that you need to look at as we grow. I just feel that it is not the right time. It's not the right time in the market, and more importantly, I believe the increase should only be $30,000, which will allow that additional director to be paid $55,000, the same amount as is currently paid, and it be reviewed in 12 months' time.
Yeah. I think, I mean, what we should have done is had this review last year or the year before. I think leaving it for 3 years and the company's changed so dramatically results in inevitably, if you're looking to, if you have a position that the directors shouldn't be paid market fees, then we won't be able to agree. But if the proposition is that existing and new directors should at least have what the market assesses, then how else do you work at a fee? But look, I understand your point. So.
Market rate has to be paid, Mr. Burns. I worry a little bit about the chairman, and we know why he's not here today. I'd be interested to know how many meetings he attends in a year. We've learned how he was so successful in a number of companies, but he hasn't been always successful. I think about Moa and others, and I just feel the 40,000 proposed as the increase for the chairman is inappropriate.
Well, the chairman's is how these processes work is that the the director is set first, and then you're applying the same percentage. To answer your earlier question, as far as I'm aware, Grant has attended every meeting for the last 2 or 3 years. This is the first meeting he hasn't, and I explained it was unfortunate and unavoidable circumstances. Do we have any other questions?
Gavin Parks again. I'm just curious, how does a board measure its own performance, and what metrics does it use?
Well, the first measurement is are we delivering on our strategy and our performance, and ensuring that the management are implementing the strategy. We have recently discussed an independent review of the board. I've been involved in 4 reviews of the board: Halliby Holdings, Top Energy, and others. They can have very limited value. The ones that have more value are the ones that are really a catalyst by the person that you bring in to raise issues of contribution and style around the board. But I don't think someone coming in to measure performance, the first criteria is, is the company delivering on what it's told the market it is going to deliver? So we are looking at an independent review, but my experience is no different from some of the other members on the board, where they've gone through these prescriptive reviews and they are really not worth the money. But we will look at how we can independently assess our performance.
Yeah, I have the first line of the corporate governance part of the annual report saying the Turners board is focused on creating shareholder value. Is that not your prime focus?
Well, I think profit performance leads to shareholder value. I mean, we've talked about the various factors on the share price, and I mean shareholder value is dividends plus increase in share price. If the share price doesn't increase, it may be due to factors, some factors beyond our control. For example, a lot of brokers you talk to lump Turners into a retail industry stock. Well, that's their call. I mean, the retail industry is under pressure. That's sort of beyond our control. What we can control is strategy to produce profit and to produce increasing earnings per share.
Yep. So given that creating shareholder value is then an important part of the board of directors' role, why hasn't the board been more conservative then with its fee increase until at least get some runs on the board for the shareholders? Because over the last 2 years, there'll be a lot of people in this room that have a red mark beside their portfolio total.
Yeah, and I agree over the last 18 months. Over the last 4 to 5 years, most shareholders would be smiling.
Yet the board's asking for a 36% increase in their pay.
The board is suggesting, or the board is saying, that directors should be paid the market value of their services. And as I said, if you don't agree with that proposition, then we're not going to agree.
Yeah. Well, I've got no regrets about, or no issues about market value, but then even looking at the strategic review, it's not based on any data points apart from their intellectual property. They haven't given us real examples. And the closest example that they gave us was on the market capital valuation, which is what you guys, as the board, looked at 3 years ago for the review. It was based on similar companies on the NZX for non-executive directors, if my memory serves me correct. And then this time, the board has employed outside party to basically booster up those results.
Yeah, I'd like you to think that we didn't tell Strategic Pay the result that we needed them to produce. They have quite an extensive database of companies, and they measure assets, they measure people, they measure sales, they measure profits. I don't think any one measure should be relied on, but we're, if you like, able, I think, to rely on their expertise to let us know the information that is correct about the position of Turners can be compared to the market, and as a result of that, to a recommended fee structure.
Yeah. So what extra value will our shareholders get for the increase in directives fees?
The shareholders have been getting very good value up until now because the board's been underpaid.
Okay, that leads me into my next question. Do the board feel they're underpaid for the work they currently do?
Well, I think the board's underpaid.
Is that mirrored by your colleagues up there as well?
Well, we can ask them.
Well, I am asking. Does anyone feel that they're underpaid for the current role that they do with Turners?
Yeah, actually, yes. I mean, apart from doing the board role,
yeah,
I was absolutely integral in working with a lead stream with the finance company, integrating those three companies, managing the rebranding of it, taking it back out to the staff, presenting it. As one example, that probably took last year, personally, about 40% of my week, each week for about 6 months.
Yeah.
So the answer is yes.
Yeah, I'm gonna add to that and say the amount of work that we do outside of board meetings, going around the country, visiting our sites, meeting with the regulators, meeting with the appointed actuaries, solving problems is actually more than any other board I have been on. I'll also say my director fees barely pays for my travel back from Asia every month, but I do this out of the learning and the support I can give to a company that I believe in.
Does the company not reimburse you for travelling?
No, I do it myself.
Okay.
That's value.
Yeah, I wasn't aware of that because it hasn't really been mentioned in the resolution, has it? Hence why we come here to ask the questions.
Okay, are there any other questions?
Yes, Roger Clark again. Look, just want to question the board in regard to earnings per share, because surely that's, earlier on we had a discussion about how you alluded to the board's disappointment in the share price. Of course, the share price is going to be affected by earnings per share. Now, if we look at the last time the board's remuneration was reviewed in 2015, according to your 5-year financial performance chart here, earnings per share were 33 cents per share. So here we are in 2018, earnings per share are only 29.3 cents per share. EPS has gone down despite the board's efforts. And on the back of an EPS decline, you're asking for a substantial increase in board fees. To me, when you look at the board remuneration for your closest competitor, Colonial Motors, listed on the stock exchange, the chairman there is managing a company with turnover of 3 times the level of Turner's. Their turnover is just on 900 million, and his annual fee is 85,000. Now, I find his approach far more reasonable than yours, and in particular in relation to Mr. Baker's new proposed remuneration of 150,000. I find that objectionable.
Okay. Look, just a comment on earnings per share. Again, one, should you base it on one measure? And secondly, you have to factor in that we've been using tax losses in earlier years. So after tax is inflated, we used all those tax losses, had to pay tax. So the after-tax earnings per share goes down. If you look at the pre-tax earnings per share, there's been constant growth. Are there any other questions?
Ed Romans, shareholder. I have no argument regarding the work that you're putting in and the value that you're providing to us, but I think the timing is a bit unfortunate. That in a year when the total return to the shareholder actually has been negative, this timing, I think, this proposal should be postponed, because the alignment, it destroys the alignment between the interests of the smaller shareholders and the board itself. So I think it's a matter of maybe postponing this proposal.
Yeah. Again, return. I think using that one measure is going to be difficult when the share price will go up and down. Does that mean next year, if we're fortunate enough to have the share price $1 higher than it is now, that the board should have double the fees? I just don't think it's going to be practical. I think the problem with the timing is that we should have reviewed the fees 2 years ago, or at least last year. Are there any other questions? Sorry, there was just a gentleman behind you that...
Yes, Edwin Stranahan again. I know for fact strategic pay usually state on whether they are looking at the directors' fees in New Zealand or New Zealand and Australia. In the case of the review that they did for you, is this based on New Zealand only or New Zealand and Australia?
No, I understand the analysis they did was based on a New Zealand entity and New Zealand market parameters.
The other point in respect of this, presumably the strategic pay, looking into it, is being done for the company. Why can't the actual report be made available to the shareholders, just like copies of the annual report when we come here or whatever?
Well, we did make the report available to shareholders.
What's that? That's the report. Sorry, what's that?
Excuse me, there was a question. There was a question in front of you, Madam.
Okay.
Yeah.
I'm both a shareholder and a proxy holder, and while I acknowledge that it is probably based on the current fees time for an increase, I'm also very, very familiar with CMC. Is there a question that perhaps the level of increase is too high, but should be looked at as a possibility of an increase, but not to the level that you're requesting?
Well, I mean, that was an option. The resolution's been drafted as it is, and it was drafted on the basis that we would put the directors' fees up to what was assessed as market value. So if you're suggesting that we limit the increase, then the directors would continue to face being underpaid until whatever appropriate time and whatever parameter was decided. So, I think that could be problematic. If there are no further questions, sorry, there's a question here.
Michael Bowden, shareholder. What would be the increase if the fees were kept the same for the additional director? If you kept the fees the same and you had this additional director, what would be the fee increase?
Well, the additional director would be paid $75,000, and if you're suggesting that the additional director paid $75,000 and all the other directors remain, I can't see the equity in that arrangement.
Well, what would be the increase you'd be looking at in that case? Is it 30,000? Is it?
Well, it would be 75,000.
Okay.
I'd like to move this motion. Do I have a seconder? Thank you. Voting, many shareholders who are not attending this meeting have voted by proxy. And I can advise that proxies have been received for 36,071,218, being approximately 42.5% of total shares on issue. If you could now complete your voting paper by ticking for, against or abstain in the appropriate place in the form, and please ensure that you sign the form, and please do not tick the discretion box. If you have any difficulty, please raise your hand and one of the scrutineers will assist you. Once everyone has finished voting, scrutineers will collect the paper. So we'll give everyone a few minutes to complete their papers before we move to any final questions and finish the meeting. So we'll pause for 2 or 3 minutes.
Okay. It's a bit worrying to see staff are the ones that are struggling to get their vote in. Dion, is there a problem? No. So it's either slow or very considered. Let's say it's very considered. Thank you. So that brings us to brings the formal part of the meeting to a close. But we're very happy to take any questions from shareholders with regards to today's presentation or the business. So I'll take those shortly. Also, directors will be happy to take further questions and discuss issues in a more informal environment following the close of the meeting. And those staff would only be only too pleased to discuss your vehicle requirements. There's a lot of very good quality stock out there, and I think Todd is counting on there being a few stock units less at the end of the day. So, are there any general questions?
Just a Roger Clark again. Look, just a silly question. I get a lot of annual reports. This is the only one I've seen stapled together by one stapler. What would it cost to actually bind it up like everybody else does?
Probably not much. Okay, let's do this.
Thank you. Are there any other questions, either silly or otherwise? But I'm not saying that was silly. All right. We'll therefore call the 2018 annual meeting of shareholders closed. Thank you very much for your attendance and your contribution. And I'd like to invite all of you to join the board and management for refreshments. Thank you.